Good day, everyone. We are the second group and we will be covering the tax credit, losses, and bad debts under the deductions from gross income.
Good day, everyone. I am Trishale G. Casikas. So I was assigned to tackle about tax credit. So first, let us define what is tax credit. Tax credit refers to the taxpayer's right to deduct from the income tax due the amount of tax he has paid to a foreign country subject to limitations. It is allowed to lessen the rigor of international double or multiple income taxation. It may also refer to the amount allowed as a reduction of the Philippine income tax. So let's go to the persons entitled to tax credit. These persons are allowed by law to claim a tax credit. First, citizens of the Philippines. Second, domestic corporations, which include all partnerships except general professional partnerships. Third, members of general professional partnerships. And fourth, beneficiaries of estates and trust. While for the persons not entitled to tax credit, these taxpayers are not entitled to tax credit. First, aliens, whether resident or non-resident. And second, foreign corporations, whether resident or non-resident. Tax credit for foreign taxes are allowed only for income derived from sources outside the Philippines. These taxpayer may not deduct tax credit. They are taxable only on income derived from the Philippine sources. Distinction between tax deduction and tax credit. In tax deduction, the taxes are deducted from gross income in computing the taxable income, while in tax credit, the taxes are deducted from the Philippine income tax itself. And in tax deduction, all taxes as a rule are allowed as deduction except for the seven kinds of taxes expressly excluded. While in tax credit, only foreign income taxes may be claimed as credits against Philippine income tax. Let's define the terms. The income taxes paid or incurred within the taxable year means taxes proper, no credit being given for amounts representing interest or penalties paid or incurred during the taxable year on behalf of the taxpayer claiming credit. Second, foreign country means any foreign state or political subdivision thereof, or any foreign political entity which lives and collects income taxes and includes the United States or any political subdivision thereof. Basis of credit for foreign taxes. If the taxpayer signifies in his return his desire to claim a credit for taxes, the basis of such credit is first, in the case of a citizen of the Philippines, the amount of any income taxes paid or incurred during the taxable year to any foreign country. And in case of an individual who is a member of a general professional partnership or a beneficiary of an estate or trust, the proportionate share of any such taxes of the general professional partnership or the estate or trust are paid the incurred during the taxable year to a foreign country if the individual's distributive share of the income of such partnership or trust is reported for Philippine income taxation. Second, in case of a domestic corporation, the amount of any income taxes paid or incurred during the taxable year to any foreign country.
Now let us tackle about limitations on tax credit. The amount of credit for foreign taxes shall be subject to these limitations. First is for taxes paid to one foreign country. The amount of the credit in respect of the tax paid or incurred to any country shall not exceed the same proportion of the tax against which such credit is taken, which the taxpayer's net income from sources within such country taxable under the tax code bears to his entire taxable income from the same year. The formula for this would be taxable income from foreign country divided by taxable income from all sources times or multiplied by Philippine income tax equals to the limit of the amount of tax credit, of course, for per country limit. For example, let's assume that a company, a domestic corporation, has taxable income from Philippine sources of 300,000 and also has taxable income from foreign country, let's say from Spain, has 100,000. So in total, a company has 400,000 taxable income from all sources. How do we get the tax credit for Spain? So let us go back to the formula provided above, which means 100,000 from Spain divided by 400,000 overall tax income equals to 25%. Therefore, the tax credit we have for Spain is 25%. So the taxable income for Spain basically was 100,000 minus or deducted to 25%, which when we compute is 25,000. Then we deduct this, which means 100,000 deducted to 25,000 is equivalent to 75,000. Therefore, the income tax payable for Spain is 75,000. Here, the main point here is our tax credit is 25% or 25,000. Next would be the taxes paid to two or more foreign countries. So the total amount of credit shall not exceed the same proportions of the tax against which such credit is taken. So which the taxpayer's net income from sources outside the Philippines taxable under the tax code bears to his entire income for the same taxable year. The formula for this would be taxable income from sources outside the Philippines divided by taxable income from all sources multiplied to the Philippine income tax. Then it is equivalent to limit of the amount of tax credit per country limit. For example, let us assume that a company, a domestic corporation, has taxable income for the following countries. Let's say Philippines for 55,000, USA for 25,000, Switzerland for 20,000. Therefore, the overall sources of taxable income is 100,000. On the other hand, we have the income tax payable of each country. We have Philippines for 30,000, USA for 10,000, Switzerland for 2,000, which results to 42,000 income tax payable. The goal here is to compute for the income tax payable by a company. So if the foreign income taxes are claimed as a tax credit, then Philippines is our domestic country, meaning we will not include it to our foreign tax. So our foreign tax only includes USA and Switzerland. So for USA we have 10,000 and for Switzerland we have 2,000. Overall, 12,000 actual foreign tax. So here's the point. Limitation number one, for sources outside the Philippines, let us compute for USA. So going back to the formula, this is how it is computed. So 25,000 divided by 100,000 multiplied by 30,000 equals to 7,500. Therefore, it did not exceed to 10,000, which was the original income tax payable for USA. Same process goes to Switzerland. Now, the foreign income taxes taken as deduction. So it is the right to deduct income taxes paid to a foreign government from the taxpayer's gross income is given only as an alternative or substitute to his right to claim a tax credit for such foreign income taxes, so that he must be entitled to a tax credit or the option to deduct from gross income. So the key points here is that the foreign tax deduction allows the taxpayers to reduce their taxable income by a portion of the amount of income tax paid to the foreign governments. The goal is to prevent citizens from being subject to double taxation for the same income. And lastly, the foreign tax deduction would be taken instead of the foreign tax credit, given that the deduction is more advantageous for a taxpayer. Next would be the year in which credit may be claimed. So we have two in specific that we could look onto. We have the accrual method of accounting and the cash method of accounting. So in accrual method of accounting, you should take the tax credit in the year in which the income from the foreign country accrued. For example, your company spends 500 organizing an event in November but doesn't receive the 1,000 payment for that event until February. So using the accrual method, your income statement will now show 1,000 of revenues in November. Additionally, the 1,000 will also be reflected as an accounts receivable, or in tax credit, the accounts refundable. So on your November balance sheet. So that is the accrual method of accounting. Next would be the cash method of accounting. So you should take the tax credit for the year in which the taxes were paid. So let us define first cash accounting. So it only records cash inflows and cash outflows and uses a single entry system in a single entry bookkeeping method. So each transaction results in just one transaction entry. For example, the cash balance for the previous month is 5,470, and you go on with your list on the days of your sheet or your record. So the 1st of March, you paid the electricity bill for the month of February for 230 pesos, and for the 3rd of March, you purchase and pay for 150 worth of products. For the 14th of March, you collect 400 pesos worth of service revenue, and so on. So basically, it is the cash inflow and outflow of a single entry. Now for the proof of tax credits. So the tax credit for foreign income taxes are available if the taxpayer establishes to the satisfaction of the Commissioner of Internal Revenue. So here are the things that we need to remember in order to provide proof. First is the total amount of income derived from sources without the Philippines. So basically from other countries, other domestics. Next is the amount of income derived from each country, the tax paid or incurred to which is claimed as a credit under the law. And lastly, generally all other information necessary for the verification, affirmation, computations of the said credit. So here you would basically see the conditions or the rules for allowance of the tax credit. So you as a taxpayer, for example, must signify your income tax return with your desired to claim tax credit. Next would be the return must be accompanied by the appropriate form prescribed by the Commissioner, duly signed and sworn to or affirmed. So it must be legally signed. Next would be the form must be carefully filled in with all of the information, basically all the information called for, and with the calculations of the credits indicated. And the taxpayer must furnish any additional information that may be required by the Commissioner. And lastly, if the credit is sought for taxes already paid, the form must have attached to it the receipt for each tax payment. So if for taxes accrued, the return on which each such accrued tax was based. Lastly is redetermination or adjustment of tax when credit proves incorrect. So basically, It says that if your documents, your receipts, your papers are proven incorrect or from your tax credit, then these are the things that you must do. So the taxpayer is required to immediately notify the commissioner in case the credit has been given for taxes accrued and the amount that is actually paid on account of such taxes is not the same as the amount of such credit. So next is any tax payment credited is refunded in whole or in part. Next would be the commissioner is authorized to redetermine the amount of tax of such taxpayer for the year of years for which such incorrect credit was actually granted. So the amount of tax, if any, shown by such redetermination shall be paid by the taxpayer upon notice and demand by the commissioner. And the amount of tax, if there are also any shown by such redetermination to have been overpaid, shall be credited or refunded back to the taxpayer.
Now we will proceed to losses. It implies an unintentional parting with something of value. So in simple terms, losses is the disappearance of things that has value. And the term losses, it is used in the income tax law in a very broad sense to comprehend all losses which are not general or natural to the ordinary course of business. It should not be covered under some other headings such as bad debts, inventory, and depreciation. Also, losses actually sustained during the taxable year and not compensated by insurance or other indemnity contract shall be allowed as deductions. Classification of losses. So for purposes of deducting losses from gross income, losses may be classified into 4 classifications. First is ordinary losses. So losses from ordinary assets are deemed normal to the taxpayer's trade, business, or profession. Hence, these are deductible in full. And under the ordinary loss is that first, losses incurred in trade, business, or profession. And second, losses incurred of property connected with a trade, business, or profession. And if due to casualty or from robbery, theft, or embezzlement. So embezzlement refers to a form of crime in which a person intentionally misappropriates the assets entrusted to them. Second classification is the capital losses. So losses on capital assets are deemed by law unnecessary expenses. Hence, these are deductible only up to the extent of capital gains. And the types of capital losses is that first, losses from sales or exchanges of capital assets. Second, losses resulting from securities becoming worthless and which are capital assets. Third, losses from short sales of property. And lastly, losses due to failure to exercise privileges or options to buy or sell property. Third classification is the special kinds of losses. Under this are first, losses from wash sales of stock or securities, losses due to voluntary removal of buildings or machinery incident to renewal or replacement. Third, losses of the useful value of capital assets due to some changes in business conditions, and it must be permanent or irreversible loss in value of assets. And lastly, abandonment loss or abandonment losses in petroleum operations. And the last classification of losses is the net operating loss carryover or NOLCO. So it pertains to the amount of net operating loss that is allowed by the law to be carried over as deduction against available net income in the following 3 years. Here is an illustration under the NOLCO or net operating loss carryover. So the following is the operating losses or income of the taxpayer. Here you can see the operating loss or income in year 1 is 300,000 and year 2 200,000. While in year 3 it has an operating income of 50,000 pesos. So here in this illustration, there is no tax from year 1 to year 2 because there is a loss. Additionally, there would be no tax in year 3 also, since this profit is merely a recovery of lost capital in the prior years. And NOLCO allows taxpayers to recover their capital losses before being fully taxed 3 years later. Requisites for deductibility of loss. And here are the requisites. First, the loss must be that of a taxpayer. Second, the loss must be actually sustained and charged off within the taxable year. So here is an illustration. First, actually sustained during the taxable year. So here, a building was destroyed by a fire in 2019. The question, may the owner of the building deduct such loss in 2020? Answer is no, because the loss was deductible in 2019 when it was sustained. Again, actually sustained during the taxable year. Second is charged off during the taxable year. An example here is a fire occurred in the city of Dumaguete, and because of which the stock of plywood of a lumber company was looted or stolen. So the lumber company must record the loss in its books of accounts in order for the Supreme Court to approve the deductibility. The third requisite is that the loss must have been incurred in trade, business, or profession. In short, the loss must be a business loss, not a personal loss. Fourth one is the loss must be evidenced by a closed and completed transaction. Fifth, the loss must not have been compensated for by insurance or other form of indemnity. And lastly, the assets loss must be actually used in a business enterprise. Under the tax code, the loss of assets not used in the course of business or personal in nature are not allowed.
Closed and completed transaction. The law requires that the loss should be sustained during the taxable year. A loss is actually sustained when it is evidenced by a closed and completed transaction. There should be an identifiable event which justifies the loss. For example, an abaca plantation in Davao was destroyed by mosaic infestation starting in 2015. By the end of that year, more than two-thirds of the plantation was worthless. Towards the middle of 2016, the plantation was totally destroyed. Now, when should the loss be deducted? The loss should be deducted in 2016 when the plantation was completely destroyed, the year when the loss was sustained in a closed and completed transaction. Were loss compensated for by insurance or other forms of indemnity. The recovery of casualty losses through insurance claims shall be governed by Revenue Regulations number 12 to 77. The amount of loss that shall be compensated by insurance should not be claimed as deductible loss. First, allowable deduction. The allowable deduction for losses is limited to the unrecovered cost, book value of the property lost or destroyed. If a portion of the loss was compensated for by insurance or other forms of indemnity, only that portion not solely covered is deductible, but the excess of the amount of the insurance proceeds over the net book value of the insured assets is not taxable income to the insured if it is used in restoring the burned property. Second, restoration of property lost or destroyed. The rule is that where insurance proceeds are actually reinvested in similar property, no gain is recognized. However, for purposes of depreciation, the insured can claim depreciation only to the extent of the net book value of the insured property, plus any additional capital outlay incurred in restoring the property, if any. In case of the total reconstruction, rehabilitation, restoration, and replacement costs of the insured assets burned are higher than the original construction and acquisition cost of the said assets or their adjusted cost basis, the excess is not a deductible loss but it shall be considered as additional capital expenditures for which depreciation may be claimed. Third, other forms of indemnity. The words other forms of indemnity as used in the tax code refers to compensation due under a title analogous or similar to insurance. The loss sustained by the taxpayer must be covered by judicially enforceable right arising from the sources of obligations, namely law, contract, quasi-contract, tort, or crime, in order that it may be considered compensated for other forms of indemnity. Where there is reasonable expectation of recovery, loss deduction will be denied if there is a reasonable right to compensate for the loss, with ultimate collection reasonably clear. So where there is reasonable ground for reimbursement, as when the loss is compensable by insurance or otherwise, the taxpayer must seek his redress and must not secure a loss deduction until he establishes that no recovery may be had. Declaration of casualty loss. First, period for filing. Within 45 days after the date of the occurrence of casualty or robbery, theft, or embezzlement, the taxpayer who sustained loss and intends to claim the loss as a deduction for the taxable year in which the loss was sustained shall file a sworn declaration of loss with the nearest revenue district officer. Second, contents. The sworn declaration of loss shall contain the following information: the nature of the event giving rise to the loss and the time of its occurrence, a description of the damaged property and its location, the items needed to compute the loss such as cost or other basis of the property, depreciation allowed or allowable, if any, value of the property before and after the event and cost of repair, and amount of insurance or other compensation received or receivable. Third, supporting documents. The sworn declaration of loss must be supported by these documents: the financial statements for the year immediately preceding the event and copies of the insurance policy, if any. Evidence to support this item should be furnished if available. Examples are purchase contracts and deeds, receipted bills for improvements, and pictures and competent appraisals of the property before and after the casualty. Proof of casualty loss. The taxpayer must prove the elements of the loss claimed, such as actual nature and occurrence of the event and the amount of loss. First, in general, the mere filing of a declaration of loss does not automatically entitle the corporation to deduct the alleged loss from gross income. The failure, however, to submit the declaration of loss within the period prescribed will result in the disallowance of the casualty loss claimed in the taxpayer's income tax return. The taxpayer should therefore file a declaration of loss and should be prepared to support and substantiate the information reported in the declaration with evidence which it should gather immediately or as soon as possible after the occurrence of the casualty or event causing the loss. Second, loss of asset in course of business. A taxpayer engaged in trade or business may be entitled to claim as business deductions casualty losses incurred for properties actually used in the business enterprise that were damaged and reported as losses in appropriate declaration filed with the BIR. The loss of assets not used in the course of business and/or our personnel shall therefore not allowed. Third, photographs taken after casualty. Photographs of the property as it existed before it was damaged will be helpful in showing the condition and value of the property before the casualty. Photographs taken after the casualty which show the extent of damage will be helpful in establishing the condition and value of the property after it was damaged. Photographs showing the condition and value of the property after it was repaired, restored, or replaced may also be helpful. Since the evaluation of the property is important in determining the amount of loss sustained, the taxpayer should be prepared to come forward with documentary proof such as cancelled checks, vouchers, receipts, and other evidence of cost. Fourth, robbery, theft, or embezzlement losses. The taxpayer bears the burden of proof and no deduction will be allowed unless it shows the property was stolen rather than misplaced or lost. A mere disappearance of property is not enough, nor is a mere error of shortage in accounts. Failure to report theft or robbery to the police may be a factor against the taxpayer. On the other hand, a mere report of alleged theft or robbery to the police authorities is not a conclusive proof of the loss arising therefrom. Fifth, substantiation of casualty losses. Relative to the substantiation of casualty losses arising from typhoons and other natural disasters, the deduction of assets as capital losses must be properly recorded in accounting reports with the adjustment of the applicable amounts. In the total loss of property used in the business enterprise, the net book value immediately preceding the natural disaster should be used as a basis in claiming losses, and shall be reduced by the amount of insurance received. The restoration of the damaged property or the acquisition of the new property to replace it must be properly recorded and recognized as either repairs or capitalized asset. The appropriate treatment of the property will be governed by the financial accounting and tax accounting rules and must take into account the nature of the transaction, the value of the amounts involved, and other factors.
Hello everyone, I am Maria Teresa Pidilada and I'm going to tackle the determination of amount deductible. So first, in general, the amount of casualty loss deductible is limited to the difference between the value of the property immediately preceding the casualty and its value immediately thereafter. So, it shall not exceed an amount equal to the cost or other adjusted basis of the property or depreciation costs in the case of property used in business, reduced by any insurance or other compensation received. So A. Method of valuation. First, the fair market value of property immediately before and immediately after the casualty. So for the purposes of determining the amount of casualty loss deductible shall be ascertained by an impartial but competent appraisal. This appraisal must recognize the effect of any general market decline affecting undamaged property, which may occur simultaneously with the casualty in order that any deduction shall be limited to actual loss resulting for damage to property. Second is the cost of repairs to the property damage is acceptable as evidence of the loss of value. So, if the taxpayer shows that, first, the repairs are necessary to restore the property to its condition immediately before the casualty. Second, the amount spent for such repairs is not excessive. Third is the repairs do not cover for more than the damage suffered. And fourth, the value of the property after the repairs does not, as a result of repairs, exceed the value of the property immediately before the casualty. So for the illustration, first, property used in businesses, which is total destruction. In case of losses arising from total destruction of property used in businesses like ordinary asset. So the net book value, like cost less accumulated depreciation, is immediately preceding the casualty should be used as the basis in claiming losses, also to be reduced by any amount of insurance or compensation received. So as the illustration shows, the example of the amount deductible is that the acquisition cost of 10,000 less by the accumulated depreciation of 5,000, and the sum of this is the amount of loss suffered by the total of 5,000. So what we do here is that the amount of loss suffered, which is 5,000, less to the amount recovered through insurance to the amount deductible of 2,500. So for the second illustration, partial destruction. In case of losses arising from the partial damage of property used in business. So the replacement cost to restore the property back to its normal operating condition should be used for purposes of computing deductible losses. But in no case shall the deductible loss be more than the net book value of the property as a whole immediately before the casualty. The excess over the net book value immediately before the casualty should be capitalized subject to depreciation over the remaining useful life of the property. For example, as what the illustration shows, that the acquisition cost is 100,000 and the accumulated depreciation is 90,000 pesos. So if we less the acquisition cost by the accumulated depreciation, the total amount is 10,000 pesos, which is the net book value. So estimated remaining useful life in 5 years. So the replacement cost of damaged portion is 20,000 pesos. So this example is the loss deductible for tax purposes would be limited to 10,000 pesos, which is equal to the net book value of the whole property. So the net book value is 10,000 pesos and the replacement cost is 20,000 pesos. So the total of 10,000 pesos if you less the replacement cost to the net book value, and the result is the excess of replacement cost to be capitalized. Next, second one is in robbery, theft, and embezzlement losses. The amount deductible in respect of robbery, of theft, and embezzlement loss shall be determined consistently with the manner provided for in determining the amount of casualty loss allowable as deduction. So, for this purpose, the fair market value of the property immediately after the theft shall be considered to be zero. The rules do not apply to the losses reflected in the inventories of the taxpayer. Next is the adjustment of losses. So proper adjustment must be made in each for expenditures or items of loose property chargeable to capital account. And 4. Depreciation, obsolescence, amortization, or depletion. So the amount of the loss must be reduced by the amount of any insurance or other compensation received and by the salvage value, if any, of the property. So the illustrative problem. For example, a building was constructed at a cost of 15 million pesos years ago. Subsequent additions and improvements were properly capitalized amount to 1 million pesos. The building was insured for 10 million pesos against fire and has accumulated depreciation of 6 million at that time. It was totally destroyed by fire. The claim for fire loss was settled with the insurance company paying 9 million pesos with the agreement that any materials that may be salvaged from the fire shall be taken by the owner of the building. Proceeds from sale of salvage material amounted to 100,000 pesos. So, as what the illustrative example shows of the computation of deductible use is that the cost of building, which is the 15 million pesos, and we add the addition and improvements to the cost of the building, and the total cost is 16 million pesos. And the total cost be deducted by the accumulated depreciation, which is 6 million pesos. And as a result of 10 million pesos as a book value. So, the book value is deducted by the insurance collected by 9 million pesos and as a total of 1 million pesos. So, the total of this is deducted by the proceeds from sale of salvage materials, which is 100,000 pesos. So, the deductible loss is the total of 900,000 pesos. Next is the voluntary removal of buildings. First, demolition incident to renewal or replacement. Loss due to the voluntary removal or demolition of old buildings. The scrapping of old machinery, equipment, etc. Incident to renewals and replacement will be deductible from gross income. So second one is demolition with a view to erecting another building. When a taxpayer buys real estate upon which is located a building, which he proceeds to raise with a view to erecting thereon another building. So, it will be considered that the taxpayer has sustained no deductible expense on account of the cost of such removal. The value of the real estate exclusive of all improvements being presumably equal to the purchase price of the land and the building plus the cost of removing the useless building. Next, loss of useful value. First, change in business condition. When through some change in business condition, the usefulness in the business of some or all of the capital assets is suddenly terminated. So that the taxpayer discontinues the business or discards such assets permanently from use in such business. He may claim as deduction the actual loss sustained. In determining the amount of the loss, adjustment must be made. However, for improvements, depreciation, and the salvage value of the property. This is an exception to the rule requiring a sale or other disposition of property to establish a loss. Second is proof required. The loss of useful value required proof of unforeseen costs, because of which the property has been permanently discarded, as for instance, where an increase in the cost or exchange in the manufacture of any product makes it necessary to abandon such manufacture, to which special machinery is exclusively devoted, or where new legislation, directly or indirectly, makes the continued profitable use of the property impossible. Third, when deductible. So loss of useful value does not apply to a case where the useful life of property terminates solely as a result of those gradual processes for which depreciation allowance is authorized. So it does not also apply to inventories or to other than capital assets. It applies to buildings only when they are permanently abandoned or permanently devoted to a radically different use, and to machinery only when its use as such as permanently abandoned. So any loss of to be deductible under this exception must be charged off in the books of fully explained and in return of income. Next one is shrinkage in value of securities. The term securities as used in the tax code means shares of stock in a corporation and rights to subscribe for or to receive such shares. A person possessing stock of corporation cannot deduct from gross income any amount claimed as a loss merely on account of shrinkage in value of such stock through fluctuation of the market or otherwise. So the term includes bonds, debentures, notes or certificates or other evidence of indebtedness issued by any corporation, including those issued by a government or political subdivision thereof, with interest coupons or in registered form. The loss allowable in such case is that actually suffered when the stock is disposed.
Securities becoming worthless means shares of stocks considered as worthless. Shares considered as worthless refers to shares when offered for sale or requested for share redemption. No amount can be realized by the owner of the share. If shares of stock held as an investment or otherwise became worthless, the cost or other basis may be deducted in the taxable year in which the stock became worthless, provided a satisfactory showing of its worthlessness is made. This refers to shares which has totally lost its value. It is a deductible loss only on the year it became worthless, provided there is a sufficient evidence of the loss. Wagering losses. These are losses from wagering transactions that are allowed only to the extent of the gains from such transactions. Meaning, you can only claim a loss from a wager as a deduction only up to the extent of the gains declared from such transaction. Abandonment losses in petroleum operations. If a contract area where petroleum operations are undertaken is partially or fully abandoned, all accumulated exploration and development expenditures pertaining thereto shall be allowed as a deduction. However, accumulated expenditures incurred in that area prior to January 1, 1979 shall be allowed as a deduction only from any income derived from that same contract area. In all cases, notices of abandonment shall be filed with the Commissioner of Internal Revenue. Meaning, all accumulated exploration and development expenditures are allowed as a deduction from a partially or fully abandoned contract area where petroleum operations are undertaken, provided that notice of abandonment needs to be filed with the Commissioner of Internal Revenue. If a producing well is subsequently abandoned, its unamortized and undepreciated cost shall be allowed as a deduction during the year of the abandonment. However, if production is resumed, the cost of the equipments shall be part of the gross income of the year of resumption or restoration and shall be amortized or depreciated as the case may be. Losses in farming operations. Livestock purchase. Livestock purchased are allowed as a deduction if loss due to disease, exposure, or injury or order from the government. Amount deductible is equivalent to purchase price less depreciation cost less cost of insurance recovered, if any. Cost of other property. Cost of other property may be claimed as a loss net of depreciation if said property is destroyed by order of the authorities. Also, if reimbursement is made in whole or in part, such amount received shall be treated as income on the year it is received. Continuation of losses in farming operations. Shrinkage. If farm products are held for favorable markets, no deduction on account of shrinkage in weight or physical value or by deterioration in storage shall be allowed except as such shrinkage as may be reflected in an inventory if used to determine profits. So, shrinkage in farm products such as shrinkage in weight or physical value cannot be deducted as loss. Next, loss by storm or etc. The total loss by storm, flood, or fire for a prospective crop is not deductible loss in computing net income. Next, value of animals that perish. A taxpayer engaged in raising and selling stock, cattle, sheep, horses, etc. is not entitled to claim as a loss the value of animals that perish from among those animals raised on the farm, except as